Hey, welcome to Market Week in Review for the week ending July 17th. I'm Paul Eidelman, and I'm joined today by my colleague Bei-Chen Lin from Investment Strategy. Today, Bei-Chen, I think we want to talk about three topics, some of the early second quarter earnings results and what we're seeing across both the U.S. economy and global economic picture here. So maybe we could start with you in terms of how you're seeing the early second quarter earnings results here in the United States.
Yeah, it's early days, Paul, but so far the results have been pretty strong, especially considering that going into the earnings season, people were already setting a very high expectation. They were expecting S&P 500 earnings growth of around 24% year over year. And already out of the first handful of companies that have been reporting so far, we're now seeing blended earnings growth already beat that very high bar of 24%. And this comes on the back of a Q1 earnings of 20% year over year for the S&P 500. And to put these numbers into context, as you know, the longer term average earnings growth rate is only about 8%. So far, this is a pretty strong start to the US earnings season. And as we look globally as well, there's some pretty high expectations for earnings growth in other parts of the world as well. But maybe turning a little bit more to the macro side of things, I know this has been a busy week for US labor market data, US inflation data, as well as some other data points. What have you been focused on, and what do you think investors should be focused on?
Yeah, if I had to describe the U.S. economy in one word this week, it'd probably be Goldilocks, where we're seeing both healthy growth, but also weaker inflation data at the same time. On the growth side, I think three data points stood out to me this week. First, on the labor market side, gosh, like initial jobless claims continue to be super low, so we're not really seeing signs of a layoff cycle here, which is really encouraging. And then on the growth side, both retail sales and some of the regional Federal Reserve Bank surveys came in stronger than expected, suggesting that economic activity is healthy, if not picking up a little bit at the turn into the second half of the year. And then maybe more important than that is inflation. There have been a lot of concern in interest rate markets recently around how high inflation has been and if that might force the Fed to push towards rate hikes. This week, both the consumer price and producer price data for the United States both undershot the consensus pretty substantially and point to something like 2% annualized U.S. inflation for the month of June. So that was applauded by U.S. fixed income markets this week and helped to lower Treasury yields at the front end of the curve. So we saw the two-year yield move down around 5 basis points. In Fedland, the market was toying with whether or not they might need to raise rates in July. That pricing has come down a lot too and is viewed as a pretty remote possibility right now. So that's the U.S. picture. How are you seeing kind of the global environment right now?
We had a Bank of Canada meeting this week. They left interest rates unchanged at 2.25%, broadly in line with expectations. The challenge for them is that they've been dealing with sort of two-sided risks. One from the Middle East conflict, where they're worried about the effect onto inflation. And the second is in terms of trade policy uncertainty, where we still haven't seen a deal yet on USMCA. But as we all know, the score can't remain 0-0 forever, and eventually the Bank of Canada will have to choose between supporting growth or dealing with inflation. And given that inflation for now is pretty close to their target, we think that it's more likely they're going to focus on supporting growth, and we could potentially even see another rate cut by the BOC later this year. Now, turning to other parts of the world, we got a lot of data from China this week. Their GDP numbers came in a little bit softer than expectations. And part of that is because consumption in China still remains relatively weak. And so the Chinese government, we expect they're going to roll out more stimulus to be able to support the economy. But ultimately, if you look at consumption as a share of GDP, in China, it's only about 40%. In the US, it's closer to 70%. So they do have a lot more work to do, but we do expect that they're going to be rolling out more stimulus.
Thank you, Bei-Chen, and thank you all for tuning in to this week's episode of Market Week in Review. We hope to see you again next time.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.